Deutsche Bank explained. Are they bust and are they the repo bailout? I'm going to share with you some shocking insights that I can promise you've never heard. So let's go ahead and dive right in. And I'm going to explain this to you in 3 simple steps. Step number 1, we've got to understand derivatives when you're dealing with Deutsche Bank. And this is not as complex as it seems. For starters, let's go with CDS, credit default swaps. Let me introduce the players to you. We've got the insurance company or the insurer. It can be a big bank. We've got a pension fund that needs to invest. We have Crappy Corp, which is C-rated or their junk-rated debt. And then we have Quality Corp, which is right on the cusp. They're rated BBB. Down here we have a hedge fund. They're a player in this. And of course, we have the ratings guy. It's New Year's or close to New Year's Eve, so it looks like he's throwing down some cheap vodka there. We'll call him Moody. And I just came up with that name out of the blue, of course. So the pension fund will want to invest, or they'll want to buy some of Crappy Corp's debt because it's yielding 5%, and they need to make their pension fund target of at least 7%. So keep in mind, they're probably doing this with leverage. The problem is Crappy Corp is rated C. And by law or by their mandate, most pension funds cannot invest in any type of debt other than what we call investment grade. So that's nothing below a BBB rating. To solve this problem, the pension fund goes to the company that would provide insurance or the credit default swap. And they say, listen, we really want to give Crappy Corp money, but we can't, so we want to buy some insurance from you because your rating is AA or investment grade. And this allows them to get around that mandate because technically they're not really lending the money to Crappy Corp, or the money isn't guaranteed by Crappy Corp. The money is guaranteed by the entity that has an investment grade rating. The pension fund agrees to loan Crappy Corp $1 million in our example, and Crappy Corp pays them that 5%. Well, the pension fund takes 1% of that and gives it to the insurer. So they keep the 4%, and for that 1% fee, the insurer gives them that insurance, that credit default swap. So the way that this would look on that $1 million is Crappy Corp pays $50,000 a year. $40,000 of that would go to the pension fund, and then the $10,000 left over would go to the insurer for that credit default swap. But in this situation, the pension fund has to invest a lot more than $1 million. So we'll say that they're going to invest $10 million by buying Quality Corp's debt. And they don't have to buy a CDS to invest in their debt because they're rated BBB. The hedge fund sees this and says, wow, we're pretty sophisticated. In fact, we're a lot more sophisticated than these dummies over at the pension fund. And we can look at the books of Crappy Corp and we can tell that they're going bust. They're not going to be in this game for long. So the hedge fund goes to the insurer and says, hey, if you're giving these guys insurance on $1 million, we'll take insurance on $100 million because we think that they're going to be bankrupt within the next 6 months or a year. So the insurance company says, well, we know better than that. We know their books better than this hedge fund. So we'll sell you a credit default swap, even though you have nothing to do with lending them money. It's a total side bet. We'll sell you $100 million worth of credit default swaps for that same 1% fee. So the hedge fund says, deal, you got it. Now, those credit default swaps, believe it or not, are an asset on the hedge fund's balance sheet. So the hedge fund goes to your local bank, we'll call them Goldman Sachs, and says, hey, we've got all these credit default swaps. They're as good as gold. We want to borrow money from you at a super cheap rate against this asset. Again, in air quotes. So the bank says, sure, we'll give you some money. Let's call it $10 million. The The hedge fund takes that $10 million and buys stock with it because they know that there's a Fed put. They think that this is guaranteed money. And let's not forget about Moody. He's super important because he's giving the credit rating to not only the corporations, but also to the insurer. And this AA rating is the key. Without that, none of this works. You can see how the incentive structure really gets skewed. And I'm sure you can start connecting the dots on how this systemically holds a lot more risk than just a simple transaction between the pension fund and Crappy Corp. So what can go wrong here? And I'm sure you're probably asking yourself, George, that's a rhetorical question. What can't go wrong here? Let's start with a downgrade of the insurer. So Moody looks at this and says, man, they're taking on a lot of these credit default swaps. 100 million here, 1 million here. And bear in mind that the entity doesn't have to have the 100 million. They don't have to have the million. They could have $0 and still sell these credit default swaps. So Moody looks at that and says, yeah, that's a little risky. We're going to downgrade them from AA down to, let's say, BB, because that takes them under that investment grade threshold. The first thing that would happen is the pension fund would have to sell all of Crappy Corp's debt because it's no longer backed by anything that's investment grade. The hedge fund would most likely have their loans called by the bank because the ratings on the credit default swaps that they have would go down. That means the value of those CDSs go down. So they would have to sell all of their shares that they bought with that money that they borrowed from the bank using the CDSs as collateral. That creates a stock sell-off for Quality Corp's shares. Well, Moody would see that and potentially downgrade Quality Corp as well. If Quality Corp gets downgraded, that means that the pension fund would have to sell their debt because they're no longer investment grade rated. As a result of Crappy Corp having to pay more for their debt because they no longer have pension funds as a buyer, and because their share price is going down, they most likely would go bust. If Crappy Corp goes bust, then the insurer would most likely go bust because they're on the hook for not only the million here, but the 100 million over here that they don't have the cash for. Well, that would most likely make the hedge fund go bust as well because they're taking out all this leverage and gambling it in either the stock market, the foreign FX market, the repo market, based on this as collateral. If that collateral goes poof to dust, then they've got big, big problems. So from that one downgrade, it would be very possible that this whole house of cards could come crashing down. And believe it or not, that is the best case scenario. And that's why Warren Buffett calls derivatives financial weapons of mass destruction. Next, you need to understand interest rate swaps, or IRSs, as they're called, if we need an even worse acronym for IRS. These are really easy to understand, but it's the biggest part of not only the derivatives market, but also Deutsche Bank's derivatives book. And we're going to get into that in just a moment. Quality Corp has an adjustable rate loan. We'll use the same numbers from the last example, $10 million at 5% interest, but they're really worried about interest rates going up. They don't know if they could afford to have it go up to maybe 8 or 10%. A corporation has a fixed rate loan. Let's say that's $10 million at 7%, but they're thinking that interest rates are going to continue to go down. They're looking at how much interest they're paying on their debt, saying, my goodness, this is terrible. Why did we do this deal at 7% when I know interest rates are going down to 2% or 1%? So these two corporations call each other on the phone and say, hey, listen, we'll go ahead and do an interest rate swap. which basically means that Quality Corp is assuming the interest rate, that 7% fixed rate for A corporation, and A corporation is assuming the adjustable rate that Quality Corp has. So the way this would look on an annual basis is Quality Corp would pay A Corp $700,000 because that's the interest at 7% for a $10 million loan. A Corp would pay Quality Corp $500,000 because that's the current interest rate on their $10 million loan. You can see that there's a big risk for A Corp if rates go up to, let's say, 10%, because then they would be on the hook for paying $1 million a year in interest instead of the $500,000 that they're paying now or the $700,000 that they were paying initially. Now we insert Deutsche Bank. If Corporation A wasn't here, Quality Corp goes to Deutsche Bank and they say, we really want our interest rate fixed. We're willing to pay this $700,000. Deutsche Bank says, fine, we'll take that risk. We'll go ahead and pay whatever this adjustable rate is, and we will pocket the spread. But if interest rates go above the 7% that Deutsche Bank is receiving from Quality Corp, they are taking a loss. That is what you call a bilateral agreement, meaning that there's just two parties that go back and forth. There's a third component of an interest rate swap, which ironically was set up after the great financial crisis to reduce risk. And it's extremely ironic. Check this out. It's called a CCP, or a central counterparty. And believe me, there's no party involved here at all. The way the regulators set this up is for Quality Corp to have a bilateral agreement with A Corp. It has to be processed through this central counterparty clearinghouse. And that can be none other than Deutsche Bank. And the reason the regulators did this is because if one party defaults and they don't make the payment, then Deutsche Bank would come in and assume the risk for the party that defaulted for a small fee. So that's the two ways that Deutsche Bank can be involved with interest rate swaps, either directly through the bilateral agreement or as the clearinghouse in the CCP, or central counterparty. Step number 2, we take a deep dive into Deutsche Bank's derivatives book. And this is where we put our investigative hat on. It gets really, really fun. So buckle up, let's dive right in. The majority of their book consists of interest rate swaps, the same swaps we talked about in the earlier segment. They break them down into two categories: OTC, which is over the counter, and exchange traded. Exchange traded would mean that they're buying and selling swaps in the open market when they think that there's a profit opportunity. The OTC is broken down by the bilateral agreements. That's where Deutsche Bank is taking one side of the interest rate swap, or CCPs, where Deutsche Bank is playing that middle party in taking on the counterparty risk in case one side defaults. And just as a reminder, I've got that example from the last segment where Quality Corp is now HSBC. Let's get real and call a spade a spade. A Corp is SoftBank, and they've got $100 billion of interest rate swaps that they're trading. And Deutsche Bank can either be the central counterparty in the transaction, according to the new European regulations, or they can be one side of that trade, and that would be the bilateral agreement. The total of their derivatives book equals 43 trillion euros. I want to point out that that's a notional value. What does that mean? If this was a $100 billion transaction, an interest rate swap between HSBC and SoftBank, the notional value of this transaction for Deutsche Bank, even though they're just a counterparty, would be 100 billion. So you got to remember that their derivatives book could be much, much higher in value than their actual balance sheet. Deutsche breaks their book down into maturity dates. Editor, go ahead and throw up the actual spreadsheet right now. So you see the 1 year, the 1 to 5 year, and the 5+ years numbers, along with the totals. And the total notional value of their interest rate swap book is 35 trillion. But I really want you guys to notice that the notional value of their book with a 1 year or less maturity is the majority. That's 18 trillion. More on that later. So Deutsche Bank puts a value on this part of their derivatives book at $21 billion. But there's several problems with that, as I'm sure you can imagine. Number one is, how do you value this? Where do you even start? If we go back to this transaction between HSBC and SoftBank, if you're Deutsche Bank in the middle and you're collecting a small fee for being the counterparty, for holding all that risk for this 100 billion, what is that worth? Who knows? And that's one of the main problems. Additionally, if we go back to that spreadsheet, you can see that Deutsche Bank is valuing their entire derivatives book at 20 billion. Well, how on earth does that work out when just the interest rate part of it is 21 billion? This shows how good Deutsche Bank is at derivatives. So they've got multiple categories. I just talked about interest rates because that's the biggest portion of the book. They've got currency, equity, credit, commodities, and other. These are all additional derivatives. And quite frankly, Deutsche Bank isn't too good at this section. For their currency book, Deutsche Bank themselves, not a ratings agency, Deutsche Bank themselves value this at 3 billion. Their equity book, a negative almost 4 billion. Their credit book, a negative 184 million. Their commodity book, negative $1 billion. And other, we just throw it in for good measure, a negative 157 million. So out of the 6 categories of derivatives that are on their book, they're losing money in 4 of those. That is not a very good batting average. And we haven't even talked about the risks involved with being on the other side of that bilateral trade or taking the counterparty risk. Let's just say with the bilateral trades that they have exposure to $7 trillion, that interest rates actually go up. Well, remember our last example where they were getting paid 7% and they were only paying out 5%. But that's an adjustable rate. So if rates go from 5 to 10, they're on the hook for the spread between the 7 and the 10. So that additional 3%. But remember, to be involved in this transaction, Deutsche Bank doesn't have to have any money set aside. None. Zero. So if this trade goes against them, where are they going to get the money for that additional 3%? More on that later. And with the CCP, their big risk is that we have a recession because they take on all the risk for one or both of these groups paying. If one of these groups goes bust, HSBC, and that's not too far of a stretch, then they assume all of the payments to SoftBank or vice versa. So a recession also puts them at tremendous risk. I would go so far to say that if we have interest rates go up or a recession, that would take the value of this part of their book from 21 trillion down to 0, if not into the negative. Now we really need to look at the clues that all of these numbers are telling us that'll help us answer the question, is Deutsche Bank the recipient of the repo market bailout? That's the question that we're trying to answer, and we're going to get to that in step number 3. But some of these clues that I want to point out is that Deutsche Bank is trying desperately to sell their derivatives book. And they've been doing this for quite a few months. But what's really interesting is that the majority of their derivatives book, these interest rates, mature in less than 1 year. So why would they be so adamant about selling this derivatives book when the majority of it, or the majority of their biggest position, matures in less than 1 year? Why don't they just hit the reset button and take 18 trillion off of that 43 trillion in notional value? It doesn't really make sense until you compare it with their losses for the year. Editor, go ahead and pull up their quarterly performance, if you want to call it that, from Yahoo, and you'll see the incredible losses that Deutsche Bank has had quarter by quarter. So obviously, at the beginning of the year, they looked at this book and they knew that this thing was a ticking time bomb. And they tried to unload it to whomever would give them pennies on the dollar. They couldn't do it fast enough, so they had to absorb all of those losses. I also want to point out that according to Yahoo Finance, Deutsche Bank's market cap is currently $15 billion. But remember, they're valuing their derivatives book alone at $20 billion. So that means that the market is valuing their core business at negative $5 billion. Step number 3. This is where we connect all the dots. So if you're a little confused right now, don't worry. It's all going to make sense in a moment. Deutsche Bank retail services are valued at negative $5 billion. How can that be? Because negative interest rates right now make it almost impossible for banks not to lose money. With that flat yield curve, they borrow short and lend long. So there is no profit opportunity for the retail banks right now in Japan and in Europe. Since their derivatives book is right on the brink of losing money, this puts Deutsche Bank between a rock and a hard place. What do? You can't make any money on the retail side because of negative interest rates, and your derivatives book is a complete disaster. So they've come to the conclusion that they're going to do one thing. It's a Hail Mary. Check this out. Editor, let's throw up the headline. That's right. They are getting back into the business of credit default swaps. Can you believe this? You cannot make this stuff up. The financial weapons of mass destruction. That's what they are turning to for that Hail Mary pass. And that's why I discussed it at the beginning of the video. It's all going to tie in. Oh, but wait, there is more. Let's not forget about the clues. We know Deutsche Bank wants to sell their derivatives book badly. They've suffered huge losses this year, and they're losing in 4 of the 6 categories of derivatives. Most of their derivatives book matures in 1 year or less and is the CCP, or the central counterparty. That's when Deutsche Bank gets in the middle of this trade and assumes the risk for one of these entities not paying or going bust. So what all of this is telling me is that Deutsche Bank at the beginning of the year looked at this exposure, this $10 trillion that they have in exposure, and saw the parties involved, call it HSBC, SoftBank, or usual suspect A, B, and C, just go ahead and fill in the blank, and said, whoa, we want no part of this at all, because we see their books and we can tell how close they are to going bust or being completely insolvent. So Deutsche Bank tries to sell that book however they can, as quick as they can. They can't do it, so they have to take all of these losses for some of these entities that might not be paying their counterparty. And so you can say, well, George, but none of these entities have gone bust. And somehow Deutsche Bank is continuing to stay afloat, even though they're taking all of their cash flow from the only little section of their business that's profitable and using it to basically pay everything where they're losing money. And they're basically robbing Peter to pay Paul. Where is Deutsche Bank getting this money, and how have none of these entities that Deutsche Bank was obviously so worried about at the beginning of the year, how have they not gone bust? Where are they getting money? One place: the repo market. I want to personally thank the following people for supporting the channel via PayPal: Donald Johnson, Ivan Hristov, Gregory Olicki, Billy Garrett, Daniel Barton, Cesar Gonzalez, Todd Scott, Dwayne Coates, Cody Painter, Zulu Defense, New Style, CKQ Enterprises, and AAA Pet Services. Thanks again to everyone for supporting the channel, and if you'd like to help out with the future creation of this type of content, we'll put a PayPal link in the description below. For more information like this, check out this content right here, and I will see you on the next video.